Are you looking for ways to grow your wealth in 2026 without putting it at risk? The world of investments is full of opportunities, but with increased volatility and market uncertainty, it's more important than ever to find low-risk options. If you're interested in securing your financial future while minimizing your exposure to risk, this guide is for you. We'll walk you through 8 reliable, low-risk investment strategies for 2026 that can help you achieve steady returns while protecting your money from market turbulence. Whether you're new to investing or a seasoned investor, these options can provide stability and growth in an unpredictable economy. 1. Intermediate-term government bonds. 5-year maturity. In 2026, intermediate-term government bonds, particularly those with a 5-year maturity, are emerging as a top low-risk investment choice. Experts have identified this duration as the sweet spot, offering higher yields than short-term cash while remaining insulated from the high volatility typically associated with long-term debt. A 5-year maturity allows you to lock in a reliable fixed income, providing stability to your portfolio. These bonds are ideal for those looking for consistency and security in their investment strategy. As the financial landscape remains unpredictable, government bonds offer a safe haven for conservative investors who don't want to expose themselves to the unpredictable swings of the stock market. With the current economic volatility and inflation concerns, locking in a stable income stream through these bonds becomes even more appealing. As interest rates fluctuate, the bond's fixed yield ensures that investors maintain a steady stream of returns over the investment period. Moreover, these bonds often appreciate in value when stocks face downturns, acting as a ballast in your portfolio. In times of market turbulence, government bonds become more attractive, driving up their price and providing you with a hedge against equity market declines. This makes them a reliable asset during market corrections, offering protection for your portfolio when other assets are falling. Another key benefit is that government bonds are virtually risk-free, as they are backed by the full faith and credit of the government. This provides a level of security that most other investments cannot match, ensuring that your principal is preserved. In addition, unlike stocks or high-yield corporate bonds, government bonds offer low correlation with the broader market, making them an excellent choice for diversification. This makes them a perfect addition for conservative investors looking to diversify their portfolios without exposing themselves to substantial risk. By including intermediate-term government bonds in your strategy, you'll enjoy the safety of a government-backed investment along with the stability that comes with predictable, reliable returns. 2 high-quality, AAA-rated corporate bonds. If you're looking for higher yields but still want to minimize risk, high-quality AAA-rated corporate bonds are an excellent choice. These bonds are issued by financially elite companies with minimal default risk. Due to their strong credit ratings, these corporations have a proven track record of stability and can afford to offer investors attractive returns. Currently, these bonds offer higher yields than government bonds, which is especially appealing in today's low-interest rate environment. Specific index funds focus on corporate bonds maturing by the end of 2026, allowing investors to predict the returns and make informed decisions. These bonds are ideal for those seeking to earn a predictable income stream with minimal risk, particularly in a world of rising geopolitical uncertainty and fluctuating fiscal policies. By investing in these corporate bonds, you are tapping into the stability and profitability of top-tier companies without the risk of stock market volatility. 3. AI-driven infrastructure debt. The demand for infrastructure, particularly in areas like data centers and power grids, is surging in 2026, driven largely by the growth of artificial intelligence, AI, and the digital economy. This trend has created a new class of volatility-light investments, AI-driven infrastructure debt. These investments allow you to gain exposure to the booming AI industry while minimizing risk. Investing in infrastructure-focused debt or funds can provide steady, contract-backed cash flows, as opposed to the unpredictable nature of volatile tech stocks. The infrastructure projects funded by these investments tend to have long-term contracts, which makes them stable, income-generating opportunities. As the world continues to demand more data and power, infrastructure investments become even more secure, offering a low-risk avenue to benefit from the AI boom without the fluctuations of traditional tech stocks. 4. Gold and silver ETFs. Gold and silver have long been seen as the ultimate safe haven investments, particularly in times of geopolitical instability or fiscal policy changes. As we move further into 2026, these precious metals continue to play a crucial role in hedging against inflation and economic uncertainty. Gold and silver exchange-traded funds, ETFs, provide an excellent way to invest in these assets with superior liquidity compared to physical bullion. Gold ETFs, in particular, have seen remarkable returns in recent years, some funds experiencing gains as high as 72% due to their role as inflation hedges. By investing in gold and silver ETFs, you gain exposure to the safety of these precious metals without the need for physical storage or the risks involved in buying and selling physical gold. For conservative investors, these funds provide a stable, low-risk way to protect your wealth against inflation, currency devaluation, and other economic threats that are expected to persist into 2026. 5. Dividend-growing index funds. Dividend-growing index funds are another low-risk investment strategy that provides the dual benefits of passive income and capital appreciation. These funds track dividend aristocrats, companies with a long history of consistently increasing their dividends. These stocks are often well-established, profitable businesses with strong market positions, which makes them an excellent choice for investors seeking stability and regular income. By focusing on companies with a track record of raising dividends, these funds offer reliable returns that grow over time. Additionally, dividend-paying companies tend to be more resilient during market downturns, as they usually have strong fundamentals and customer loyalty. Investing in these funds can provide a steady income stream while also helping your portfolio grow through reinvested dividends. This makes dividend-growing index funds an attractive low-risk option for anyone looking to build long-term wealth. 6. Guaranteed evergreen private funds. The rise of evergreen or tender offer private funds offers retail investors an opportunity to access private credit markets with lower minimum investments and periodic liquidity. These funds target asset-backed lending, which provides more stability than publicly traded equities. The key benefit of evergreen funds is their ability to provide liquidity at certain intervals, offering investors a way to access their funds while still receiving attractive returns. Unlike traditional private equity investments, which are often illiquid and require large initial investments, evergreen funds allow you to invest with lower capital requirements and more flexibility. This makes them a great option for conservative investors who want exposure to the private credit market without the risk and illiquidity associated with traditional private equity funds. These funds target assets with tangible value, such as real estate or machinery, making them a safe and predictable option for low-risk investing. 7. Global value equity rotation. In the face of high concentration in the U.S. tech market, experts suggest rotating into value equities in developed markets like the UK or Japan. These markets currently offer lower valuations and more balanced leadership, which reduces the risk of a bubble burst. By investing in global value equities, you can diversify your portfolio and mitigate the risk associated with investing heavily in one market, such as the U.S. tech sector. These international markets offer opportunities for growth without the high risk that often comes with speculative stocks. With lower valuations, these value stocks can provide solid returns with less volatility. By rotating into these markets, you diversify your portfolio and protect yourself against the risks of market concentration, making it a smart move for low-risk investing in 2026. 8. Fixed-term, paydar or Islamic income plans. For investors seeking capital preservation with modest, predictable growth, fixed-term Islamic income plans, like the Mizan Paydar Munafa plan, are an excellent choice. These plans are specially designed to comply with Sharia law, providing guaranteed returns for a set period. These plans offer a safe and stable investment option, ideal for those who prefer ethical investments. Fixed-term Islamic income plans provide returns that are not only predictable, but also free from the risks associated with traditional investments. Because these plans focus on asset-backed investments, they are considered a secure, low-risk choice for long-term wealth building. Whether you're an investor seeking ethical options or someone looking for guaranteed returns, these fixed-term plans can offer peace of mind in an unpredictable financial environment. There you have it, the top 8 low-risk ways to invest in 2026. From government bonds to dividend-growing index funds, these strategies offer stability and predictable returns in an uncertain market. If you found this video insightful, don't forget to like, share, and subscribe for more updates on smart investing and financial strategies. Let me know in the comments which investment option you'll try first. I'll see you in the next video.